Okay, so we're going to continue with our discussion from, I'll just make one administrative note. In your spreadsheet, in your master spreadsheet for your kind of like your website for the course, notice I've started adding market videos. In this particular course, you'll be trading options. So I will put in certain, I've left the reports in place for IPM. I will add some more links here. As far as lecture videos are concerned, so I'm just going to, I may not be able to upload every lecture here, but I've given you the playlist. If you just bookmark the playlist, you will get the entire list of lectures. So I think right now you'll see only 2 lectures are there. But if you click the playlist at any point of time, you will get all the latest lectures. I think the easiest way to access all the lectures. All right. So this is your lecture link. So you can do that. And yeah, all 20. All right. Okay. So I won't be uploading every video here. And we'll just continue with the rest of the material. So we will continue now with we are continuing with our discussion of all the decision problems you have to deal with. And we were dealing with 6.1, which is how to exit at a, when do I exit with a profit? Okay, so that's your decision problem. If you have, and we will actually have probably options on the QQQ. As you know now, the US election is quite near. So the stock market is reacting in all kinds of interesting ways, reacting to the election prospects. And the 2 candidates have quite different implications for the economy. So the stock market is reacting to all that. So we will have options on SPY as well. All right. Okay. So what I'm going to do here is, so these are the decision problems that you face. And we are dealing with 6.1. And if we open 6.1, we open 6.1. What we handled yesterday. So there are 2 exit price with profit. Yeah, well, I was just trying to explain 6.1. What it is suppose if I had gone long at some point of time here, maybe 297, and now the market is over here. So initially I'd gone long with a stop over here when it made a new high here. But now that the market is here, well, should I take my profit now, well, before the election? Or should I, even if we don't have a special circumstance like the election in front of us, there's always going to be a question of, at one point of time, well, it's going good. I mean, it's going great for me. I'm making money. But at some point of time, I have to think about locking in my profits. And how do I do that? At what point of time do I do that? And that is not a decision to be, that price level is not to be chosen arbitrarily as to where you get out. But it is it can be done in a structured way, and there are 2 broad ways to do it: indirect and direct. So what we have discussed in the previous class is indirect, okay, which is by using a trailing stop. So in this case, if it makes a new high, then you would move the stop to here. From here, you would have moved the stop to here initially, and then so this is what we discussed. So then eventually, if it makes a new high, the trailing stop will move here. So this is what we discussed in the previous class. This is basically what we are calling the indirect solution to, so this is what we are calling the indirect solution to the 6.1 question, okay, exit price with profit. Okay, so indirect solution is the one with the trailing stop. And now we are talking about the direct solution. We can maybe indirect solution, trailing stop orders. And now we talk about the direct solution, which is active selection of exit price. Okay, by active selection, what we mean is okay, at some point of time, you already have a plan that in the case of the trailing stop, you know that is the reason we call the other one active. The trailing stop is to be seen as a passive method. We can actually write this this way: indirect solution, trailing stop orders we can call it passive actually. Why are we calling it passive? Passive because we don't actually determine the price level at which we are going to exit. Notice we are not really determining, there's obviously a price level associated with it, but the way we think about it is that we are always going to put it, if we are in an uptrend, and you can flip it up, you can flip around the logic for a downtrend. If we are in an uptrend, we are always going to put it at the highest low for whatever level of zoom that we fix up, okay? We are going to just identify the prominent highs and lows. And if we are long, we are always going to put the stop at the highest low from which a new from which the latest high was made. Okay, so if this high is exceeded here, it goes up to here, then we would put the stop over here. Right now, the stop is still at this point. Okay, or if you're using a smaller, if you're using a more a greater degree of a zoom in, then the stop might be somewhere, maybe here or something like that. Might be here if you're using these smaller lows, but we're just going to use a bigger one, and we'll say the stop is here right now. Okay. So it's passive in the sense that we are not actively selecting a particular price level. We are only selecting highs and lows already marked by the market. So the market determines the price level, and we are only selecting particular highs and lows. Okay? So that's why we're calling it passive, and we're going to distinguish it with the active selection, which is what we are going to say now. Active selection means that I will actually determine a particular price. I'll say, okay, I'm going to get out at 375. Okay, I got in at maybe 297, 298. Okay, say 300. I got in at 300, and I'm going to get out at 375. Okay, and that's what I'm going to say. Now that's here I'm directly determining the price level at which I'm getting out.
Sir,
Yeah.
sir, last class you said that direct solution is a market when we think market is not going up anymore and we exit at that price.
Which one? You're talking about the passive?
Direct solution, sir. You said market, we think market is not going up, right? Afterward, and we can exit that price.
Correct, correct. So in that case, what could happen is that indirect can be done with two types of orders, which is that either you use here, what we'll stay here, we can make a further distinction. Okay, so this is obviously using stop orders. Okay. We are here indirect solution. We are using stop orders. We can put some one highlight here. And direct solution, we are just to further elaborate on what Sachin was asking. We can actually active selection of exit price. Okay, which is that it will either be a. Let's copy it from here. So it will either be a market order or, so if I, at this point of time, if my plan is that I will exit at 375 and the market is here right now, 375 is much higher. What kind of order will I place to exit at 375? Market order, stop order, or limit order? Yes, Sachin, let's ask.
Sir, limit order.
Limit order, correct. Krish is correct. It will be a limit order, right? Because the market is here. Remember the characteristic of a limit order. It is always going to let you transact at, it'll enable you to transact at a price which is more favorable than the current market. So if I'm a seller, because when I want to take profit on a long position, I have to sell. So when I'm a seller and the market is now at 348 or something, and I'm placing an order to sell at 375, then that must be a limit order because 375 is a better selling price than 348. Okay, so that's why it must be a limit order. So Krish's answer is correct. So in this case, what we use typically is market order or limit order. Okay. In fact, maybe we can even put the limit order first. Limit order or market order. Okay. So we can actually make this whole thing. Yeah. So what Sachin is talking about is, we can talk about this here. Okay. So what Sachin is talking about is that situation which I mentioned, where so that is a general system, general statement where obviously if I see somebody getting out of a position at a particular price, he has a long position, and he exits the market at exits that position at a particular price. Okay. What I was mentioning the other day is that obviously what that person, I can conclude something, that this person thinks that this price is no longer going to go up, right? That's why he's selling. If it was going to keep on going up, then why would he be selling? Okay. There is one exception, of course, that sometimes it has nothing to do with what you think will happen in the market. Sometimes you may need the money. So you have investments locked up somewhere, you're selling something because you need the money. That's a different kind of consideration. In general, if you don't bring in that consideration, we can conclude that if somebody is selling a particular asset, which he has in which he has a long position, we can safely conclude that that person believes that the price of that asset will no longer rise. Okay. Or there is a risk of a substantial fall before it rises again. So therefore, he's trying to lock in his profits at a high level. So that's what I meant by that statement. Sachin, is this clearer to you now, what I was trying to say?
Yes, sir. Yes, sir.
So there are two ways you can do it. Mainly, we are going to focus on the use of the limit order. Okay. But to address what Sachin had raised, okay, is that you can also use a market order in the sense that, imagine that you are like a robot, and as you know, these days, you should know as a finance student, these days, one of the fads that has emerged in the market is the so-called robo advisory funds. Okay. So these robo advisory funds are essentially, these are where the stock selection is being done by robots. Okay. So Mitali had a experience in her IPM project when she was using this iBot feature on the interactive brokers, on the TWS. So this iBot is one of those types of ideas where it's a robot which makes the selection of which stocks to buy. All right. So that's robo advisory. Essentially, what they're doing is they're constantly monitoring. They're coming up with a list of what particular stocks or any other asset to buy, and then they're constantly monitoring the market. So you could also be like that. You could constantly monitor the market, and maybe you're also using fundamentals. Okay, so you can, at some point of time, you may come to a conclusion that the market's not going to go up, or you may sometimes say that because the election is now very close, 3rd of November, the US election, so you might say that, at this point, I don't want to take a chance. So because one of the candidates is Joe Biden is talking about tax increases, and Trump is going to Trump is actually talking about tax cuts, more tax cuts. So the differences are quite stark. So you may not want to take a chance. So what you do in this case, you use market orders to exit at a profit, where you decide, okay, you're monitoring the market and you find at this point that the market is struggling and it's not really maybe breaking out to the top side, too much risk, the election is nearby. So, okay, let's get out. Okay, so you were long over here, you went long. And at this point, you, for various reasons, you decide, okay, let's get out at market. Okay, all the trades are done at market, let's say in your simple system, and you decide to get out at market. And here too, when you went long, you saw the break to a new high, and then you went long. Okay, and so here you get out. So this is one way of solving the 6.1, where you continuously monitor the market. And so market order, we can clarify this in the case of the use of the market order, is where we can Okay, so this is basically what we mean. All right. So just that you're constantly monitoring when you're using a market order means you're constantly monitoring the market. Okay. Uh, we can put this also in place. That trader who's constantly monitoring the market. Feels the market may move against him sharply. Okay, so this is the less important use of the direct solution. Okay, but this is one way of doing it. So this we have discussed because Sachin mentioned that point what I talked about. But in general, also, and even when you're using a limit order, you can conclude that for any situation where a trader is exiting a long position, you can assume that he's of the opinion that the market is not likely to go up further, or is likely to decline sharply. But limit order has certain other types of interesting implications, so we'll focus on that now. Okay. So let's look at this. So if you're going to use a limit order, okay, how to use limit orders to solve this problem directly. Okay, direct solution means that active selection of exit price. Okay, active selection of, let's make it active selection of specific exit price. Okay, in the case of the passive solution, we do not select a specific exit price. We keep referring to lows, and then we just read off what the low price is. Okay, but we don't determine the price first. Okay, we identify the lows, and from there we see what the price is. Here we are going to identify the price first. Okay, directly at the active selection of specific exit price. Okay, so let's use that. Look at the use of limit orders. Okay. All right. So this is the problem that we are going to deal with today, which is active selection of limit orders, use of limit orders with specific exit price. Okay, for DP 6.1. Use of limit orders with specific exit price. Let's look at this now. Yeah, okay. So essentially what we are talking about is, if we are going to now, what we are talking about is, say if I was long from here, now I'm saying that I'm talking about solving DP 6.1 directly by using a limit order, which means I'm going to now determine a particular exit price ahead of time where I would like to lock in my profit and so-called take profit, the language that we use, the slang that we use in the market, take profit. I need to set a limit price for my take profit order. That's the problem. That's the decision problem I have right now. Now, should it be 375? Should it be 400? Should it be 500? What should it be? Okay, how do you determine that? That's what is important here. Okay, so what we do, the way we proceed with that is, obviously what we are trying to determine is the target profit per trade. Okay, so it says that specific exit price a specific exit price with profit. Okay, so what we are saying is that we are trying to follow the logical steps. Okay, let me put this here so that we'll first lay out the logical steps, and then we will give you some further information on what is required to go through those steps. Okay, but first understand the logical steps. We'll write down the logical steps first. Okay, logical steps. So what we are saying is that this decision problem. So I went long here, and now I'm going to determine a particular price at which I'll exit. 375, 400, 425, whatever it is. Now that what we are saying is that is not something you should determine arbitrarily. Obviously, you can also arbitrarily choose a price as long as it's higher than your entry price. Then it becomes a take profit order because it's higher than your entry price in the case of a long position. But what we are saying is that there's a structured way to determine that exit price. And what is that structured way? We'll come to that. Okay, this is what we are going through, the logical steps. Okay. Uh, so what we are saying here is that the logical steps to set the specific exit price with profit. What are the logical steps? Okay, so what we are saying is now specific exit price with profit, okay, is a, we don't need the steps over here. Specific exit price with profit is a function of the target. This TDT is target, okay. I hope everybody understands, but we'll write it in the way. Target, this is profit. Target profit per trade. Okay, so it is a function of target profit per trade. So what should be my specific exit price with profit? That is a function of, it's going to be a function of target profit per trade. Okay, which is obviously because if I decide to exit at a particular point, 375, let's say, I know how many units I have, bought. So if I take my entry price and then I take my exit price, whatever the exit price, that that will basically set a particular profit per trade. So what we are saying is, first of all, that this is going to be determined by what is my target profit per trade, which means before I can determine this, I will have to determine this. And it is this thing that is going to drive this selection. Okay, because if you remember, we have a formula which is, you remember we have a formula where we have this formula, right? So this profit can be taken as PNL as well. Okay, we can write it as PNL as well in a more general sense. Profit is a very specific statement. Profit refers to the P part of the PNL, and PNL is a more general statement because it includes the concept of loss as well. Okay, so just to be in line with the general framework that we had discussed earlier, I have just written PNL, but in this particular module, we are going to be largely discussing with respect to profit, because the decision problem we are solving is 6.1, which is exit with profit. Okay, so the first statement we are making in our logical steps is that the the specific exit price is profit is going to be a function of the target profit per trade. So we'll work out this first, and from there we'll come to this. Okay. Now target profit per trade, okay, can also be. Now we'll go stepwise and try to see this. Okay. So we'll say is that it is a function of total trading profit or we can call it per period. Okay, any period, it could be quarterly, whatever period we can just take. We'll just write one period. We'll target trading profit per period, total trading profit per period. This is also a target figure, so we should write that. Maybe we can bring it here. Okay, still doesn't go. I just like to see everything together. This font is too big actually. We don't need 16. We can make everything 14. Yeah, that's much better. Okay. Okay. So yeah. So we have target profit per trade, which is going. We first said that this is a function of this. So and then what is this? How are we going to get to this? So well, we're going to get to this by again coming from this. We will first determine what is the target total trading profit per period. Okay, per period means any quarterly, 1 year, whatever trading period you're evaluating. So target total trading profit. Okay, so this total trading profit we are calling gross profit. Okay, there's a reason for that. We'll see. Okay, let's call it gross profit. Okay. So the reason we're calling it gross profit is, so we are setting this equal to this. We're just using a particular term to make it similar to, normal companies whose balance sheets and all we look at. So where let this equal to gross profit, where gross profit is going to be equal to, maybe we should just write profit properly. Let's put some more letters in and write profit properly so that where this gross profit, okay, is equal to, we'll put some line gaps in between so that you can see it clearly. All right, where gross profit is equal to, we'll put it this way. Let's put it this way. Just copy from, if we have your, from your, since I'm quite lazy, I'm going to talk about total profits minus total losses. All right. So, Lalita, I'm in a class. I'll call you after 11 o'clock. Yeah. Okay, so let's talk about this. So total profits minus total losses. Okay, so we can put trading profits here. Total trading profits minus total trading losses. Okay, so you could call it gross net profit also if you wanted to. These are just terms that we are cooking up. So this part is not so important, but we are just going to, for the purposes of our exercise, we'll call it gross profit because it's similar to the company's idea of a gross profit where you have like sales minus cost of sales, etc. So that kind of terminology, you want to be similar to that. So therefore, we'll just keep it this way, and let's make everything here. All right. Okay. So right. So total trading profit is equal to gross profit, where gross profit is equal to total trading profits minus total trading losses. Okay, so all profits adding up all your profitable trades minus adding up the total loss number from all your trading, all your losing trades. Okay, so that's gross profit. So what we are saying, exit price, specific exit price, is a function of this. This is a function of total trading profit per period. Okay. Now, where will we get this total trading profit per period? Target this number because this will import, this will affect, right? Let's write it this way now. This comes from, again, we are using the same kind of terminology which we have used before. Total trading profit per period, target total trading profit per period. Yeah, what we are going to say is target total trading profit per period. Let's try and make this a little bit so that it fits in one line. Let's try. Good. Now it's fitting here. Okay, so this is investor mandate. Okay, now you have used this term before, remember? We have just said that when you solve the first three decision problems, when you solve the question of which asset classes, which markets, and which instruments, these are usually solved by the investor mandate. As you will see, in this project as well, I'm going to give you a bunch of project tickers. So I'm like your investor. So I am constraining you to trading in only particular kinds of particular markets. And I'm also determining in this case, you'll be trading US equity option and only certain tickers. So therefore, I am determining asset class as equity. Markets will be certain US markets, and within that also a smaller set of US markets, probably around 20 markets that I'll give you. And then instrument is going to be options. Okay, so you can't trade spot, you can't trade futures. I'm constraining you to trade options only. So just like we said, asset just DPs 1 to 3 are determined by the investor mandate. There's something else here, 6.1 also. There is a role for the investor mandate, but that's a different part of the investor mandate. Okay. So the investor, one of the things that the investor can give you, so indirect or direct investor mandate, let's talk about a direct investor mandate. Okay. So we say required or a target, we can call it return on IC. What will IC stand for here? Anybody? What is
invested capital?
Come again? Invested capital.
Yes, sir.
Correct. It is invested capital. Okay, so IC is invested capital. And what is the other type of capital we talked about in this context? Other than invested capital?
Risk capital.
Risk capital, correct.
Risk capital.
Risk capital. So I hope you remember the distinction. Invested capital is what you have invested. This is a function of your liquidity. But most people don't want to lose, are not willing to lose all of their invested capital, although they don't think about it beforehand. But there is a concept that you should think about, which is out of this money that I have deployed in the market, which is a function of my liquidity, how much am I willing to lose? And that is called the risk capital, which you should always think about in advance. Okay. But generally what happens is, because this distinction which we made earlier in IPM itself, where we talked about invested capital versus risk capital. But generally, people in the industry don't think about risk capital too much. This is a mistake, actually, but this is the way it is, so we can't change reality. So you will find that when investors have discussions with their fund managers, they talk about, when they're talking about a required rate of return, okay, let's put a percentage number here so that we know what they're talking about. Yeah, required return that we are talking about. When they have this discussion with their fund managers, they usually talk in terms of a return on invested capital. Okay, so I might have given you $100 million to invest for me, although I'm willing to lose only $40 million out of that 100 million. But when I talk to you as my fund manager about the amount of return that I expect, I will usually have that discussion with respect to return on invested capital. It's not really logical, but this is how it works in the real world, okay? So we are going to frame our analysis in terms of this kind of a setup, okay? So the direct investor mandate is where the investor says, so I'm giving my money to, say, Mitali to invest, and I tell her that, okay, I need 115% return on my invested capital, okay? So that's one way of doing it, which is a direct investor mandate. Or you could also have a indirect investor mandate. Where basically the fund manager, you'll notice this. This actually is done by the fund manager, not by the investor. That's why it's put the investor in inverted commas. Fund manager decides to target he decides to target a okay. So here what happens in the case of an indirect mandate, the fund manager decides to this is the investor's pair. This one is given by the investor. Okay, direct investor gives it. Here the fund manager determines. Okay, so you might actually sometimes come across funds where in their prospectus or in their marketing documents, they will make statements like this fund targets a 15% return. Okay, it's actually a kind of stupid statement because we should not be making statements about things we can't control. Now, obviously, you can't control your percentage return because you don't know how the market will move and what positions you'll be able to, successfully take and ride through. So nobody knows what return they're going to make. So it's kind of stupid to talk about, a particular target return. But a lot of stupid things happen in the industry. So you'll very often find people talking about a target return on invested capital. Fund manager will say that my fund targets a 15% return. Okay? They won't even use the concept of invested capital, but they just talk about return because they don't know the difference between invested capital and risk capital. They don't really think about it. So this is another way of it. So what we mean, what we mean when we say indirect investor mandate is where the fund manager himself decides to target a particular ROIC, which is always this usually happens because the investor is the fund manager is targeting a particular class of investors. Okay, so it's just like like for instance, if you hear the famous story of Steve Jobs and the iPhone and those the removing the physical keyboard. It's not that Steve Jobs did a fund. He didn't do any survey. He didn't do any kind of focus group or any kind of survey to find out what customers wanted. He himself just looked at the phone and said, "This is a stupid design." He looked at the BlackBerry and he decided on his own that this is a stupid design. I think that the customer will want a kind of a screen-based keyboard, and there's no need to have the physical keyboard, and we can use that to create extra screen space. So this is an example of kind of like the same kind of thinking where Steve Jobs himself decides that I think this is what the customer wants, and so I'll give it to him in my product. And I'll create my product in such a way that I think that it contains a feature which the customer wants. So similarly, the fund manager is thinking that, okay, if I say I am going to target a 15% rate of return, I think that the people that I'm trying to market this fund to, they will like this idea of a 15% return. Okay, so that's how it works. And so, but always remember that this is whenever you see people talking like this, please remember that these are stupid statements because nobody controls how much money they make. So therefore, this statement doesn't make any sense. But then human beings are not rational creatures. Okay, we do a lot of stupid things. So therefore, you'll find in the industry as well, a lot of things happen which are not particularly rational. But this is how life works. Okay, so so this is basically what we mean by the indirect investor mandate. So either way, what is happening is that we are ending up with a target ROIC. Okay, ROIC here is return on invested capital. We can put this here so that we know what we're talking about when we put this. Yeah. Okay. So what is happening is either the investor tells you directly that I want you to target this kind of return, or the fund manager himself decides that I am going to launch my fund, and when I market my fund to investors, I'm going to say I'm going to be talking about a target return ROIC of 15% or whatever percent you decide. Okay. So this is what I mean by direct or indirect investor mandate. But I hope you can understand now that, let's say whatever number we've come up with, I hope you can understand now that if you have, once you know the invested capital figure, once you know this figure, okay, and once you know the target ROIC percentage, okay, you can Therefore, total trading profit can be determined. I hope everybody understands that. Okay, that when you have a target ROIC and you have the total IC figure, okay, once you have the total IC figure and you have the target ROIC, you can figure out the target total trading profit, because it is just as simple as, which is what we have done here, right? So target return on invested capital, let's say, is 112.5%. I've done these numbers here. This is in your calc file. Okay. The name of the sheet is R3. You'll understand what R3 is very soon. So how do I get the target gross profit? Gross profit here is total trading profit. Okay. Gross profit is total trading profit. Now, this terminology is not correct actually, because we are defining total trading profits as only the total of the profitable trades. So this should be actually the gross profit. So you understand why I'm doing this, because I have defined total trading profit as only the total of the profitable trades. But here what I mean is actually the gross profit, which is total of profitable trades minus total of losing trades. So this is what I'm talking about. When this number comes target gross profit, you can see here target gross profit. Okay. How do I get this 5.6 million? How does it come from? Let's look at it. Yeah, you can see that. I hope you guys can see this formula when can you see the highlights also? I hope you can see the highlights.
Yes, sir.
One of the cells is highlighted here, G7, and the other is C2. Okay, good. So yeah, so you can see this. So how do I come? So this 5 million is, what is this? This 5 million, as you can see here, the font is a little small. I wanted to fit it into the column. So this is IC, okay, in dollar thousands. So I make this cyan is the input cell. So usually I make my input cells with cyan color background. So so 5,000 is what I enter, but actually this is 5 million because it's in thousands. So $5 million is my invested capital. Okay, that's what is connected to. And the investor investor has told me to target this percentage return, ROIC. So therefore, my target gross profit is this into this. Very simple. Okay, everybody follows from so far. So when I have 5 million figure, 5 million IC, and ROIC is this, target ROIC is this. So therefore, target gross profit is this. Okay. So we are going stepwise. Remember, our ultimate goal is to determine a specific exit price per trade. Okay. For any given trade. And how are we going to come to that? We are going step by step. At any point of time, if you don't understand how this step came about, you have to ask a question. Otherwise, you will not understand the later steps. Okay. Now, where are we? Target gross profit. So we have figured out this. Okay, we have figured out our target gross profit, which is 5.625. Okay. Now what we do is, what we have to do is, this is what we have already done. That we can put this here. Actually, we don't need this statement. Yeah. You can write this here essentially. that okay. So target ROIC comes from there. We get for a given period, we get the target gross profit. We already done this. Okay. Put this here. Just trying to make sure we have the right sequence of steps. You understand what this is. So from the target gross profit comes from the target return on IC, and the target return on IC comes from direct or indirect investor mandate. Okay. Now what we do next step is we estimate the trading system parameters. Okay. We have to do this exercise. We have to estimate the trading system parameters. By trading system parameters, we mean only the estimate trading system parameters. By trading system parameters, we mean these kind of things: number of trades, okay, maximum average loss, okay, maximum risk per trade. Average loss is equal to maximum risk per trade. Percentage losers, okay, so which is basically trading system parameters. Estimate trading system parameters. By that I mean certain things like number of trades, percentage losers, etc. Okay, so you look ahead to your trading horizon, upcoming trading period, and you estimate how many trades are you going to do. So let's say 180 trades. This can be any period, quarter, 1 year. So let's say 1 year, and you have a plan to do 180 trades, and you expect that 75% will be losers, losing trades. Okay, so from there you can derive the number of losing trades, which is 135, which is basically 75% into G3 into G2. Correct. G3. Yeah, why is it showing E3? Okay, that's just a copy that I did. Yeah, okay. Yeah, so it is this into this. Okay, G3 into G2. Okay, 75% to 180. So you have 135 losing trades. You can figure out the number of winning trades. Okay, and you can also figure out the percentage winners is 25. And okay, this is also something you specified. What percentage of my invested capital is going to be RC? In this example, to be specific, I have given the unlikely number of 100% because that is rarely the case. Usually that is not true. Usually it's not true that IC, 100% of IC is equal to RC. Generally not true. So especially in markets like stocks where you can't, you have basically there's a lot of money that needs to be deployed where you're not willing to lose that much money. So therefore, but in this case, we have taken it as 100% for the sake of simplicity. Okay, so that gives us the risk capital figure as well, and from there we can also derive the average loss, which is average loss is basically maximum risk per trade. Okay, so we can write this also. So not fit on one page, but if you just to refresh your memory, average loss is also equal to maximum risk per trade. The font may be a bit small here. Maybe we can make it a little broader. I just want everything here to fix. Maybe yeah, make this a little bit bigger. So that when you look at it, you can make it a little bigger. We'll make it 14. So easier to read. So average loss is equal to maximum risk per trade. As you can see, average loss is equal to maximum risk per trade. Okay, so this is also an important number that we want to look at, which is where is G13? G13 is here, risk per trade, G8 minus G16. Yeah, you can figure out what we did just to recap your memory. G8 by G16 and G total number of, okay, so here I've determined something different actually from 180. Let me make it simpler and make it 120. Let me make it okay, so let's keep it. I don't want the other figures to be disturbed, which I've computed. Even if we make it, what happens? A lot of things will change. Okay, so let's keep the original disturbance. So this is an additional tweak that we have. If you remember when we first discussed it, okay, we have discussed the determination of maximum risk per trade as by setting. So if you, what we had discussed earlier, the first simplest way to determine the maximum risk per trade is we said that if you're projecting 135 losers, okay, you're going to assume that all 135 losers are going to happen right from the very beginning. So the first 135 trades are going to be losing trades. That's what I discussed with you. That's the simplest way to do it and the safest way to do it, because then you will never have a negative surprise if these estimates are correct. Okay. So what I've done here is a slight improvement, or you can call it improvement or further complication on that, adding another line of another level of flexibility. What I have done here is now I'm saying that instead of blindly making this blindly assuming that all 35 losing trades will be stacked together in the beginning, you put in another line, element of flexibility into your calculations. You separately estimate what I call the maximum run of losers from the start. Okay, which means out of my, so this number can't be more than 135 from here, can't be more than a total number of losing trades, but it can be less. So you can separately estimate that, well, I'm not going to have 135 losing trades in a row. I'm going to have only maximum 120 losing trades in a row. Okay, from the very beginning. So that's why you see that this dollar risk per trade is determined as G8 minus G16. So this G8 is the risk capital figure, total risk capital figure. And instead of dividing by the total number of losing trades, which is what I taught you to do earlier, here we are making a slight, we are introducing a little more subtlety into the system, where the trader is separately estimating the maximum run of losing trades that will happen from the beginning. Okay, so obviously this number can't be greater than the total number of losing trades. Total number of losing trades here is 135, but I'm saying out of that 135, only a maximum of 120 will be stacked together in the beginning. Okay, so that's why we're dividing the $5 million RC by the separate estimate of maximum run of losers from the start, that is 120, instead of the total number of losing trades, that is 135. Okay, so I hope everybody has understood this particular tweak. There's a slight, modification of the algorithm from what we learned earlier, which was the first basic step. Now we are, making it a little more complex by introducing another element of flexibility. Okay, I hope this is clear to everyone. Okay, so this is how we get the maximum dollar risk per trade. Okay, average loss dollar risk per trade. So this is what I mean by estimate the trading system parameters. At this point, we are now, these are the steps that we have to take. Okay, we are going to determine that this is going to be a fund. So let trading total rate is the gross profit is the target gross profit will be, yeah. So what we'll do is one of the steps is basically estimate target gross profit, which we have done. Okay. All right, so estimate target gross profit and target return on invested capital. Okay, and that comes from the invested capital and the target ROIC. Then you estimate the trading system parameters, various parameters that we discussed here. You estimate these parameters because you're going to need them. Okay. So now what you do is, now we come up with an interesting concept is what we call calculate Let's put this system edge. It's a new term that you're learning. We'll explain what it is. Okay. We'll explain this term here. This is a very important concept that you should understand. Very simple, actually. Okay, so how do I write this? Target gross profit. Um, yeah, so we will calculate the system edge, and for that we will use these two variables. I'll put this here. This will not make sense right now. What we are saying here is that to calculate the system edge, we will take the target gross profit plus the number of trades, which we have already calculated because we have estimated trading system parameters. So we will have this figure, and we already have this figure, and these two will give us the system edge. Okay, from these two figures we can get the system edge. But let's first understand what the system edge is. Okay, so the system edge, let's put the this looks a little more complicated than it actually is. Once we explain it, then you will understand. Okay, this would be, we will put a little bit lower down. Steps, okay. So let me explain this thing. Okay, system edge. What is a system edge? So we are saying next step is calculate system edge. Now, what is system edge? So it's a very simple concept. Okay, it's the expectation of a trading system, and so based on projected, if it is projected, we call it ex ante. Now, you guys are familiar with this expression, ex ante. What is the opposite of ex ante? Anybody remembers from lab? I've already given you the answer, but you should remember it from your lab session, from your lab materials. Ex ante or ex post. Okay, ante means before, post means after, obviously. All right. So system edge can be either if it is based on projected performance, then it is called ex ante. If it is based on realized performance, that means you're looking back on your last year's trading performance, the trading performance for last year, then we will call it the ex post system edge. Okay? So generally we talk about the projected number. Okay. Now remember these terms. Okay, very simple terms, but let's put this away. Remember this concept. Let's try to put it away and get you to answer certain questions. Okay, based on projected ex ante, projected number is more important. Okay, system edge, mathematical expectation. You remember these terms from statistics? Mathematical expectation, we also call it expectation. Okay. I think you already remember this term from before. Let's look at this. Session board, let's go to session board. Okay. Let's say that we are trying to estimate the average rainfall that will happen next month in Delhi. Now, we don't know what the, it's going to be 1020 or what? Today is, no, it's actually 1019. All right. So expectation, when we are talking about mathematical expectation, this is a concept that you are familiar with, I think, from your statistics class, that you should remember actually. So let's say we are going to talk about rainfall in Delhi next month, average rainfall, and probability, or let's call it the outcome. Okay, these are the general terms that we use. So I don't know what's going to be. I'm trying to make a forecast about the future outcome. I'm not trying to make a forecast about next month's average rainfall in Delhi, average daily rainfall in Delhi, but I'm not sure what's going to happen exactly. So what I do is I state it in terms of probability. I say that there is a 35% probability that the average rainfall will be 10 centimeters. Okay. Then there is a 40%, 45% probability that the average rainfall is 15 centimeters. Okay. Then there is this brings us to 80. So there's a 20% probability that the average rainfall will be only 2 centimeters. Okay. So what is the expected, what is the expectation of, daily rainfall and average daily rainfall in Delhi for the next month? What is the expectation? How should I arrive at the figure? Anybody wants to tell me? Question is clear. We are trying to figure out what is the mathematical expectation. This is a term that we use in statistics. We also use the word expectation, more used in finance. They mean the same thing. So what is the expectation of average daily rainfall in Delhi for next month based on this input that I'm giving you? Who is going to answer this?
Then you can take average of the outcomes. That is
Average, average how?
We'll multiply the probabilities with the outcome and then take sum.
Alright, good. So I should do here like this. Okay, that's what you're saying, right?
Yes, sir.
Doing this. Each step we are doing probability time outcome, times outcome, probability times outcome, and then we are, so in terms of our expectation figure, we can just write it as sum of these products. Okay, correct? Is this correct? Okay. I have taken each probability into the outcome, PIXI. So this is written in statistics, is written as summation PIXI. So I have done the PI, these are the PI, these are the XIs. Okay. This is PIXI, P1X1, P2X2, P3X3, and this is summation PIXI. Okay. So I have just added these. So that means the expected expectation of average daily rainfall in Delhi next month is 10.65 centimeters based on this forecast data. Okay. Now this, I hope you guys understand that this is nothing but this is something which is nothing really new. This is a weighted average. You understand? We already know what weighted average is before we come to statistics and mathematical expectation. We just call it expectation. Before we come to expectation, we already know weighted average. And I hope you understand that this is not something new. This is actually just a weighted average. What it is a here the only difference is the probabilities are the weights. Can you see this? This is actually a weighted average. Okay, so it's nothing new actually. So we are going to tie up three concepts together. We are going to tie up weighted average, expectation, and system edge. And what we are going to show you is that actually those three concepts are just one concept applied in a slightly different way. So the real concept is the weighted average, which you already know. Okay, I hope everybody understands this. That expectation is nothing but a weighted average. It's not a new concept. It's a weighted average where you're replacing normal weights by probability weights. So it is a probability weighted average outcome. Expectation is nothing but a probability weighted average outcome. Okay. Similarly, when we come to our mathematical expectation of the system edge, that's why I removed it, because I wanted to get the answer from you. Okay. All right. So the way we write the system edge is like this. Percentage losers into average loss. Okay, this is your maximum risk per trade. Average losing trade, you should be losing only the maximum risk per trade, not more. Plus average winners, percentage winners into average profit. Okay. Now, this is the equation of the system edge. This is what we mean. As you can see, this is exactly the same as mathematical expectation of as the expectation of the system. Okay, so it's PIXI. If you have a system where you have a certain this percentage losers is essentially like a historical idea of this idea of frequentist vision of probability. Okay. Okay, so there is, I just write it here. Maybe I should write it in this. Uh, I'll just write it here. Uh, you should know these terms. Actually, these are big words, but have you guys done Bayes theorem? Probability? Did you do Bayes theorem? Conditional probability? No?
Yes, sir.
Done it. Okay. So this is the term that you should be aware of. So we either talk about a frequentist, probability approach or a Bayesian probability approach. A frequentist approach is a more static approach, which looks at historical frequencies. A Bayesian probability is more dynamic and it looks at conditional probabilities and all that. So here we are using a frequentist vision of probability, where what we say is that percentage losers into average loss plus percentage winners into average profit. This is the expectation of the system. So we know what the percentage losers is times average loss. Percentage losers is like the probability of a loss. So the historical frequency gives us the probability of a loss. Okay, the historical frequency of losers, and here the historical frequency of winners, percentage winners. So this is just nothing but 1 minus. So this is how we get the mathematical expectation of the edge of the system. Okay. Now tell me, in this RHS, how many independent variables are in this RHS? So I'm focusing on this RHS. My question is, how many independent variables can we see here? Let's ask Ketan. Yes, Ketan. Whatever, Ketan is sleeping. Okay, let's see who else can we ask. Let's ask double A. How many independent variables can we see here?
So percentage losers depend on number of trades,
Okay.
and percentage winners also depend on the total trades.
Yeah, but I'm just, you don't have to tell me what these depend on. I'm saying that here, how dependent,
Sir, I think all of them are dependent.
all are dependent? No, okay. So in the sense here, see, when I make this equation like this, it's obvious that edge is the dependent variable. System, the independent are these on the right hand side, okay? But I'm actually asking you, how many of these are actually independent of each other? So here it seems like we have four parts to the argument, okay? But how many, the point okay, let me just cut a long story short. What I'm trying to say here is that there are only 3 independent variables here, not 4. Because once you know percentage losers, then percentage winners is equal to 1.
Yes, sir.
That's all I'm trying to do.
Yes, sir.
That's all I'm trying to do.
Sir, your voice is not clear.
My voice is not clear now. Is it clearer now?
Yes, sir.
Percentage. 1 minus percentage losers. Okay, percentage winners is equal to 1 minus percentage losers. That's what we're trying to say here. So there are only 3 independent variables here. Okay, right. So what we are saying here is, yeah, we'll come to that. So this is the idea. So first, understand the expectation, the edge of the system. Okay, percentage losers into average loss plus percentage winners into average profit. So you can see an application of this here. If we go back to our R3 page. where we have computed the system edge here is like this. Okay, how did we come to this? Here you can see this. I'll try to make this very small so that you can see everything together in one view, hopefully. Yeah, if you take this and now you can see the highlights. So this is actually same thing I've written. Percentage winners into average loss. Average loss is written with a minus sign. Okay, if you go into this formula, you'll see that there is a minus sign in G15. G15 is what? G15 is, where is 15? Here.
Risk per trade.
Dollar risk per trade. So I have added a minus sign before G15 because it's an average loss. So you have to write the loss as a minus sign in the calculation of system edge. So I've written this dollar risk per trade, which is also given here, average loss. Okay, that I have given it with the minus sign. So minus G15 into G3, which is G3 is your percentage losers. Okay, and here you have taken 25%. This 25 has come as 1 minus percentage losers, percentage winners. So percentage winners into average win. Average win is actually here. We'll come to that where we came to this average win. But in this system calculation, we have an average win of 250,000. So that gives you a system edge of this 31.25K. All right, that's your calculation. Save calculation. This is nothing but the application of this formula. Okay, nothing but the application of this formula. Right. So now we have, we want to just write down this thing here. We have another important thing which we are showing you, that once you calculate the system edge, we have an important calculation to do, which is we have to understand system edge. One of the implications of system edge is that if you take the system edge and multiply it with the number of trades, total number of trades, okay, not the number of winning trades or number of losing trades, no, total number of trades. If you take system edge, multiply by the total number of trades, you will get the estimated gross profit of P&L. Okay, gross profit is equal to total trading profits minus total trading losses. Where have I given that estimation here? Total trading profits minus total trading, total of all losing trades, total of all winning trades. This minus this is equal to gross profit. Okay, so what we have is this important thing here, which is system edge into number of trades is equal to estimated gross profit. Okay, so now we can test this figure. Okay, in this you can test this figure. We can go back to a little bit more slightly bigger numbers. Okay, so if you see here, if you take yeah, then we have to go back here. If we estimated gross profit, which hopefully I put this formula here, G14 into G2. What is G14? Yeah, G14 is the system edge, okay, and G2 is the total number of trades. Okay, so this will always be true. Okay, these are kind of identities, so these are always going to be true. So the total estimated gross profit, which is again you can see gross profit is equal to here. This is I think coming from the plus minus. Okay, this also I've done this a number of trades. One of these should have been just a total profits minus total losses. Okay, you can see total profits minus total losses is equal to this figure. Okay, so here you have this figure, estimated gross profit. So estimated gross profit is a function of system edge times total number of trades. Okay, this is just an identity. Okay, this is always true. So we are going to make use of this identity and use it for our calculation, okay, which we need to, the calculation that we are heading towards, okay, which is our objective here, okay, which is, okay, all right. So let's look at this. System edge is into number of trades is equal to estimated gross profit of P&L. Okay, let's look at this. In this case, we are proceeding like this. We started with the target ROIC. We multiplied that with the invested capital. to come up with our estimate of target gross profit. This is this. Now what we already know the number of trades. Okay, that's based on our estimation of trading system parameters, which we did here. Now we want to calculate the system edge. Okay, now we know that system edge is equal to number of trades. System edge into number of trades is equal to estimated gross profit. Okay, so this we can actually then write on system edge is equal to what will happen is equal to estimated gross profit divided by number of trades. Okay, that's clear. All right, so system edge is equal to estimated gross profits divided by number of trades. Okay, so if we do this calculation, we already have the can actually make it a little bit bigger also. Okay, if we already have this, so we want to find out the system edge. What do? We take the estimated the target gross profit, which we know we have to make, 5.6 million, and we have a total number of projected trades is 180. Therefore, the system edge has to be 31.25. Okay, so this we know. Now, what else can we figure out? Now, what else do we have to do? We have to actually figure out, make it a little bit smaller, 90%. Okay. Now, we have another step to do actually. So from system edge, we have already figured out the system edge. Okay. Now, I'll keep these definitions here so that we know what the system edge is. Okay. Once winners equal to 1 minus percentage losers, we can write the formula here. We've written that also. Okay. Then compute average win. Okay, that's our next step, which is basically compute the average win. And then from average win, we can compute the exit price. These are our steps actually. So we'll show you, we are just listing out the steps. Because remember, that was our goal when we started out. Okay, when we started out, we were trying to figure out the exit price at a profit. So I've indicated that as EX/P plus. If it was exit at a loss, I would have called it P minus. So this is P plus, which means exit price at profit, which is what we are trying to find out in this whole exercise. Okay, it sounds like a very complicated exercise, but that's what we are trying to do. We are trying to figure out a structured way and a logical way to determine this figure. So this is our end goal, and we are coming at it from different steps. Okay. So if you want to write down steps, we can write. Okay, we'll come to those. We'll write down those steps. We already discussed those, but we'll write it down. I'll write down the numbers more clearly, the steps. But you have understood the steps so far. We have come to the point of taking out computing the system edge, okay, by taking estimated gross profit divided by number of trades, right? So now our next job is, as it says here, the next job is actually to, from system edge, okay, to compute the, this we can put this in actually in maybe in some kind of a background here. And these are our steps actually, what we have to do. And here we say calculate system edge. Also a step. These are also steps, so we put this in blue, so that gives us the steps. Okay. figure out the target profit per trade will be coming from target total trading profit period. This will also come specific exit price is target profit per trade. Yeah, so we have to come to this. We'll come. This is actually not in the right sequence. This has to come. This has to come a little later down, lower down. But we'll keep this here. This is one of the calculations we have to do. This will come easily from here. This will be divided by total number of trades, and we'll get this. So and then we have gross profit. This is the gross profit. This we have to calculate. Okay. Have I written it anywhere here? Yeah, need to calculate the gross profit. So calculate gross profit, target gross profit. This is also one of our steps. We have seen all this. We have calculated the gross profit, okay, target gross profit. We have now computed the system edge. Now, next thing we have to do is after calculating the system edge, we have to then calculate average win. Okay. So now let's look at the formula for system edge. We can easily do this. Where is this part written? Yeah. Okay, so we can do this one calculation here. I'll clean up the sheet a little bit more, but you can clearly understand that if this is the equation for system edge, we can easily compute average win from here. Okay. Now you see I've written it as average percentage winners is written as 1 minus percentage losers. So you can see the same thing here. It's being done here. No, this is a different calculation. Let's compute from here. Yeah, we'll just look at this calculation. What are we doing now? What step are we doing now? From system edge, compute average win. How will we do that? Let's look at the formula for system edge, and we can easily see that. This is an important term. We'll highlight, we'll just put that later. So you can see that the formula for system edge is average loss. You always write the average loss with a minus sign. Okay. So average loss into, and so this you compute as an absolute value. Okay. That's what is written over here. That and then you put it in the system edge formula. You put it as a with a minus sign. Minus average loss times percentage loss plus average win times 1 minus percentage loss, which is percentage win. Okay, so we just do some manipulation here, very simple. This means that SE plus this, okay, is equal to average win into this. But this comes with a minus sign. Okay, so the whole thing can be taken to the left. Then here you have this, and then in the next step you can just write it like this: average win is equal to this whole LHS, okay, divided by 1 minus percentage L. Okay, so therefore from SE you can compute average win because the rest of them are known to you. You have already estimated the trading system parameters. So average win is this. So what we have done is here that we have computed the average win as a function of SE and average loss, percentage loss. These three independent variables. Here we have one dependent variable and 1, 2, and 3 independent variables. This is not independent. Okay, only 3 independent variables. Okay, so therefore what we have done, we have taken system edge. I have just broken down the formula over here. Okay, the LHS are broken down in 2 parts: the quotient, LHS quotient, and the numerator and the denominator. Okay, so denominator is 1 minus percentage L. Numerator is this. You can see that here. Numerator and denominator. Okay, we divide that. We come to this. Okay, so numerator by denominator, we come to this way. So since we know that the system edge is 31.25K and we have a total of 180 trades, okay, and we have so many losing trades, so from there we can determine that the average win must be 250,000. The average win, in order to produce the system edge, the average win has to be 250,000. Okay, and we are seeing the average loss is 41.667. All right, so this is your situation. Now, this other thing that you have to learn. Okay, I'll just explain one more point before ending today. That is, this is an important term, sometimes called the risk reward ratio, but mainly I think we would refer to it as R3. We just call it R3. R3 is reward to risk ratio because reward is in the numerator, risk is in the denominator. Okay, so R3. You can write it any way you want, but you have to be clear about what you're doing and you have to be consistent. Okay. So average win by average loss. That's your average win by average loss is your. I've written that somewhere here. Average win by average loss is R3. So we are going to just use this expression R3 from now on in order to explain, in order to refer to this ratio, average win divided by average loss, which is here. Here our R3 would be, just as an example, our R3 would okay. So in this case, we just compute our R3. Our average win is 250,000 and our average loss is risk per trade, which is this. Okay. So which means our R3 is turning out to be 6. Okay. R3 is 6, which means here you can also say that the reward to risk ratio of your ex ante, these are ex ante. Ex ante reward to risk ratio of your trading system is 6. If the investor is, if you're going to meet the investor's requirement of generating this kind of ROIC, then you must have a R3 of 6. Okay. So we'll continue in the next class. And so the class is dismissed. And those who have any questions can stay back and the rest can move.
Sir, I have a question.
Go ahead.
Sir, is there a difference between target profit or estimated profit?
In this kind of discussion that we are having now, there is no difference. Okay.
Okay, sir.
Because essentially we are really comparing the whole discussion in terms of our entire discussion is being driven by what the investor has set as a target. So from there we are making certain estimates. So we are not really there's not much of a difference between the two here. But in general terms, when you are using estimated and target, obviously the words have slightly different meanings. But in this particular peculiar context in which we are operating right now, there's not much difference. Okay, but it's a good question. I should also be more careful about how I'm using the word. The number of trades. Yeah, this is fine at the moment. But it's a good question actually, that we have to be very careful about the use of words. Yeah.
Yes, sir. Because sir, in the formula it was written that estimated gross profit, and sir, we have used a target, a profit
Formula in this one.
Yes, sir. System edge formula.
Yeah, we have used the target gross profit. Yeah. So actually, system edge, we see how we want to write it here. System edge into number of trades is equal to, yeah, actually we can eliminate this also, and we can just write it as gross profit. That makes it more general. Then you can either refer to it as estimated or target, whatever it is. Okay. So we can remove this actually. Okay. This I've just written estimated. You know what estimated is intimately connected to means. Estimated is really what we call, if you see here, basically the real immutable connection of estimated is to this. Okay, so when we say estimated, what we really mean is this, that estimated means really connection of estimated, which is always going to be true, is that estimated means projected or ex ante. That's what it is basically. Okay, so this will always be true, that estimated is equal to projected or ex ante. Whereas in relation to your earlier question about estimated versus target, that may not always be true. It may not always be equal to each other, but this will always be true. Okay, that estimated is always equal to the projected or ex ante figure. So in this case, you're right.
Okay, sir.
Point you have raised, that we can write our formula. This is a general formula, okay? So we can write it as system is always true. The system edge into number of trades will be equal to gross profit, okay? Where we have defined gross profit. Total trading profits minus total trading losses. So this statement, so here we can remove the estimated in the formula. We can just call it gross profit. And then you can prefix it either with estimated or target, whatever is the actual context that you're operating. Yeah. Yeah, Vipul, your questions answered?
Yeah, yes, sir. Yes, sir.
But it's good, very good question. Good. Shows that you're observing quite deeply now. You're observing what we are discussing in a very minute way. Yeah, good.
Yes,
Okay.
sir.
Another question?
Sir, Utsav this side.
Yeah.
Sir, not a question, but I have to pass on some information. First of all, Ketan has joined from his computer system and he could only use headphones.
I saw the message, yeah.
Okay, sir. And so, secondly, last night I was going through the notes, so I saw that attendance sheet file. So I thought it had viewing rights, so I clicked on it and it sent a request edit access to the PGDM office. So I received a mail from Shoma ma'am and a call from Lalita ma'am regarding that you are not allowed to edit it. I did not know it was for editing. I only thought that it was for viewing the attendance. So
let's check it out. Let's check it out. Yeah, you should have the right. The whole point of doing it this way is to give you the right to view it.
yes, sir, but we don't have rights right now. I thought we have the viewing rights. That is why I clicked on it. But it automatically sent a mail request to the concerned editors. So she called.
Yeah, okay. Let me do one thing. That's maybe my mistake. I have actually normally what I do is I put it into your folder and then you see it.
Yes, sir. I due to that only I did that. I thought it is for our viewing purposes. That is why I clicked on it. Term 6 attendance, but I did not know that we don't have the access right now. So in that confusion, a mail was sent to the office, and today morning I received a mail from Professor Shoma telling me that I don't have the right to edit, but I was not trying to edit it. I was just trying to see it.
No problem. Okay, so a couple of corrections. So don't say today morning, say this morning.
Okay, sir.
And the second is also don't say Utsav this side. Just say Utsav here. Either
Okay, sir.
Utsav here or this is Utsav. Okay.
Yes,
or
sir.
I am Utsav, or you say Utsav here, and then you say this morning instead of today morning. Okay.
Okay,
right.
sir.
Let me have a look at this. FDRM. Where is my FDR? No, this is fall 19 actually. And fall 20. Let's look at this. Daily attendance. Where is the attendance? I have attendance. Let's look at this. Let me try and launch it from here. Okay. This is the attendance for this. So when you clicked on it, you got a block. Correct.
Yes, sir. That I don't have the rights, and our edit request has been sent to the collaborators.
I'll fix it right now. Where is it? See document details. Now let it load fully. Let it load fully. By the way, I have already sent the grades last night to PGDM. Let me see where it is. Where is it? 2 students never even sent their submission. Khushbu and I think Gagan did not even submit a student's FDRM folder, FDRM for 2020. Okay, fine. So this is correct. I have placed it there. So why is it not there? Okay, let me see. Fall 2020, students fall 2020. And where is the, yeah, there's your attendance sheet. Okay. So you should be able to see it. Let me see, but it's a shortcut. All right. It's not a, but you should have viewing rights.
Sir, ma'am explained it to me in the email that the viewing rights will be given through PGDM office only. And right now we don't have the rights, so don't share the sheet or don't try to edit it.
Okay. All right. Yeah, so they have to give you the viewing rights. Yeah. Okay. Yeah, because I think I can't do that. So you can do it yourself. So she will do it, right?
Yes, sir. But I'm just giving you a heads up because even Lalita ma'am called me in the session to take information that why I was trying to edit the sheet. So I told her that it was in your folder and I was just trying to see my attendance.
Yeah, you're
So
not trying to edit, you're trying to. So you
this,
follow up. If she has said that she will do it, then I don't want to do it. Let them do it. But you can just explain to just write a mail to Lalita ma'am that it is meant to be viewed by the students. Not the students should have only view access, not edit rights. You already told her that, right?
yes, sir. Sir, every semester, this is the pattern we have. We have the viewing rights every semester of the attendance sheet. But I think this time they have not yet given us the viewing rights.
Yeah, yeah.
So I think that's why it went the